Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am joined today by Erica Muller. She is the founder and CEO of Virolio, and we're going to talk about something that we get a lot of people asking us about. We don't have a ton of, and that is short-term rentals. So, Erica, thanks for joining us today.
My pleasure. Thanks so much, Adam, for having me here. I could talk about this all day long.
Well, we're going to try to keep the episode shorter than a day. But we had Erica on before. If you want to go back and listen to the first interview we had with her, but we wanted to dive in a little bit more because there's constantly evolving real estate going on there. So, Erica, just remind people a little bit about what Virolio is, and then let's dive into just kind of what changes have happened in the short-term rental market in the last 6 months or so.
Yeah, no problem. So Virolio is data-backed short-term rental acquisition strategies. So unlike a lot of acquisition teams, we only look at markets that we back by data to be good markets. We're using data to find, and it's our own data. We built the data, we clean the data. It's the purest data on the market. So we use it to find emerging markets, to find top earners in those markets, to duplicate those top earning strategies. So our goal here at Virolio is to make sure that no investor purchases a short-term rental without seeing this data first and understands the strategy going into it and how that market's going to perform. And there's been a lot of changes in the last 6 months. Namely interest rates is something that I think everybody's been talking about, because just interest rates alone, I mean, we had lower interest rates last year and we still had high purchase prices. So there was still a lot of markets where higher purchase prices would work. But the rental market doesn't care what's happening with the, finance market. It doesn't care if interest rates go up. It doesn't care if purchase prices rise. The rental rates do what they want to do.
Yep.
And the rental rates haven't risen in proportion with the interest rates and with the purchase prices. So that's why data is so critical to constantly every month be looking at what is happening in the market, what markets are getting pushed off the opportunity list, which ones are emerging onto it. And so that's the big thing that's happened in the last 6 months is interest rates killing off a lot of these higher ticket markets where purchase prices are higher. You're going to have a higher monthly payment, and then adding additional interest to that makes the payment even higher, especially for those people that were really taking advantage of the 10% down opportunity. It's just pushing them completely out of certain markets. So big changes have been emerging markets that are now better opportunities than they were 2 years ago. And the markets that were better opportunities 2 years ago are no longer great opportunities, especially when you factor in saturation as well. So that's kind of what we've been seeing over the last 2 years. The good news, or 6 months, the good news is that tourism is still going strong. We do have the tourism data in our tool as well. And we can show that tourism is more than halfway back to where it was in 2019 before COVID. So tourism is coming back in almost every market, and it continues to trend upwards. So it's still a strong time for short-term rental. One last thing we've seen in the short-term rental industry in the last 6 months is really the rise of midterm rentals. And that's something we also work with data on as well, is to really identify those opportunities where it's not a short-term rental, it's not a long-term rental, but it's an in-between. And what that means is it's a stay longer than 90 days. It's typically a corporate rental. It's a traveling nurse. It's an insurance claim that has to house somebody for a few months. Those are really driving solid returns as well. And certain markets for those have more opportunity than others. And that's a big thing now. A lot of investors are starting to jump on that bandwagon because they can go directly to these insurance companies, these claim departments that find the housing, and they can work directly with them to keep their properties completely booked. And typically there's less heads and beds and turnaround on that. So that's the big update for the last 6 months.
Yeah, we've definitely medium-term rentals, mid-term rentals have been the buzzword around investors recently. Now, you mentioned that rents haven't kept up with interest rate increases and prices. Now, in the single-family realm, like the long-term rentals, we're seeing pretty consistent rent increases every year. You can almost always push your rent, at least $25 a month with your tenant. What is in the short-term rental market in the times that you've been studying? How quickly does it go up? Is it like 2% over a year, 5% over a year? Kind of how does the year over year rent change in short-term rentals on average? Obviously, it can be pretty variant.
Yeah, it's a good question, and it varies so much that I couldn't give an exact percentage, but it's driven by saturation. Whereas long-term rentals, you typically don't see as much with saturation because people always need a permanent place to live, especially if you're in states where people are constantly moving to, there's growth happening. Long-term rental, the demand continues to go up every year. With short-term rental, the more that you build in that area, the more that people start buying in that area and the more supply that hits the market, the lower you start to see rates actually going backwards, or you start to see them going backwards and they get lower because there's more opportunities now for the same amount of tourists. And so that's why it's so important and critical to pay attention to not only the saturation in today's market and where it's at with this market you're looking in, but where's it going in 5 years from now? Is there a lot of room for growth? Because if there's a lot of room for growth, that's actually a bigger risk with short-term rental and sustaining a higher rate than it is with long-term rental. Usually it's the opposite with long-term rental. More growth means more competition in 5 years from now. So we really pay attention to saturation, and that's really what drives the rental rate. So I would say in most markets that were sexy 2 years ago and really performing well, like Gatlinburg, Orlando, places like that, they were doing great 2 years ago, but they've continued to build, and they just keep expanding and more people keep jumping into that market. But tourism has to also grow with it. And we had that COVID in 2020, which killed tourism. And we haven't seen tourism bounce back to the original numbers that they were in 2019. So what you have is that the supply pretty much doubled, but we've cut tourism in half in a lot of markets. So that's why it's so critical that we look at emerging markets where tourism is strong and it's always been strong. We just might not have ever known about these markets or heard of them because we were so fixated on, the Gatlinburgs and the Kissimmees and those markets. And so now we're being forced to pay attention to these other markets that actually have better performance opportunity and that don't have as much risk of growing so fast over the next 5 years in the tourism sector.
Yeah, it's funny you mentioned that. I actually just read an article a day or two ago that talked about, I'm in Austin, and it mentioned that they did a study, and we can all be tracked in any and every way possible nowadays. And it was the downtown activity in Austin is still down 50%. And I think the biggest one was like San Francisco or something has only bounced back like to 20% of where it was in 2019. So yeah, it's kind of crazy how long it's taken everything to bounce back. And that's both in terms of people going into the office and people going there in the evenings and that kind of stuff. So very interesting. And yeah, in Orlando, places like that, there's only so many places you can be that are close to Disney World that that people want to stay before it gets out of there and you get too far away and nobody wants to drive that in. So we wanted to focus in today on one of the markets you like that's been growing consistently for short terms. We've been having some success there with long terms as well. And that is Cleveland, Ohio. It's not a place that I tend to think of as a short-term rental place. So tell us a little bit about why you're seeing Cleveland as a potential for, is it potential for both short-term and medium-term, or does it focus more heavily on one or the other?
Yeah, it's definitely potential for both, because medium term, we refer to it as midterm rentals. That's typically in markets where there's a strong suburban market outside of the city, and people live there. There's good schools. They need temporary housing, so they place them somewhere close by. So that kind of doesn't really have anything to do with tourism whatsoever. But on the tourism side, what was interesting to me is Cleveland was never on my radar for the last however many years. I would have never thought of it as, a hot market that people travel to. So I'm actually learning a lot about it myself over the past month as to why people are traveling there. Who are these tourists? Because unfortunately, it was never on my radar. I guess it's a good thing in one way because we would have told a lot of people about it and maybe it would have gotten a bit saturated. But now that we know, we're paying attention. So what I've noticed about Cleveland so far and what we've learned is that if we look at tourism, and I'm just looking at it on my screen right now.
Yeah, just let me know when you want me to add it to the
Yeah,
video
you can go ahead and share my screen. So first thing I'm doing is looking at how close has it bounced back to pre-COVID. And I see here in 2019, it had a number of 4.8 million domestic tourists. It's back up in 2021 to 3.5. They haven't released 2022 numbers yet, but we know we're going to have, most likely, if it follows the trend of everywhere else, we're going to have seen that probably increase closer to 4 million. So it's creeping back up, and it's more than halfway back to that original 2019 number. So tourism is coming back there, which is great. We need to know that. International, not as much as domestic. They had a much stronger international presence before COVID, but a lot of that could be due to some of the travel restrictions that have been in place for internationals, which were recently lifted. So hopefully that helps increase that tourism number there. So I do like the way that the tourism numbers look here in Cleveland. That makes me feel good about short-term rental. Second thing that I noticed is that they actually have like a big staycation market, or a big market of people. If I scroll out to this map more, so you have all these suburbs of Cleveland out here, and a lot of tourists will come in from the suburbs, or they're in a drive-to market coming in from other states that are close by, and they go into the city for a long weekend, or they go in there for a bachelorette party or an anniversary. We've been seeing a lot of stays like that, like these short but sweet type of stays. So they're like 2 to 3 day stays. They're not seeing as many, 7-day plus stays on the tourism side, but they're going here for a reason. They also have the lake, which is pulling in a lot of tourism as well. And I'm going to explain what we're looking at shortly. These dots just represent earning categories. So wherever you see the green dots, that means there's a lot of high earners in that particular part of the city. So you can see here this green dot over here, which is over by Ohio City. As we scroll in, we start to see, and we're going to actually turn off all these other earners right now. We can see a lot of these top earners here clustered around this part of the city. And as I did more research on this, and I'm still learning, there's still a lot to learn. I have a wonderful agent there that I've been connecting with, and he's been educating me on a lot of things. And hopefully, if you're interested in this market, we'll definitely be able to connect you to him as well. But what I'm learning is this is a central hub right here in this part of Cleveland for tourists, because they can walk to a lot of things, and walkability is super important. They can walk over to the water, they can walk to cafes, restaurants. And so that's been a big driving factor here. So when we're looking at Cleveland, we're really trying to focus on this area surrounding the Ohio City neighborhood. And let's look at what the returns look like. So for us to consider a market viable, we want to see, or a market that we're willing to even look deeper into, we want to see from all percentiles combined at least a 7.5 plus cap rate. Now, we want to do better than that. But what this means is that if the low earners mixed with the top earners can at least average somewhere around this number, that means that there's a lot of room for growth as a top earner. So let me show you what that looks like. So this market checks that box. It checks the tourism box. It also checks the box that people can drive to it. So in the event that we have another COVID situation, it becomes difficult to fly places, it's still a drive-to market.
Now, how do you know that it's a drive-to? Just because you can look at it and see it's not that far from a decent number of people, or is there a way to see that in the past people have actually driven there?
Yeah, so we actually look at where the tourists are coming from and how far away. And basically what that looks like in terms of, are they taking discount airlines in, like Frontier from a city that's pretty far away? Like, for example, there's a direct flight on Frontier from Orlando to Cleveland. Or how many of those tourists are they bringing in versus how many of those tourists are actually coming from within a 3-hour radius where they actually drove their car? So we look at those kind of numbers to determine if something's a drive-to market. And so what I'm going to do here is I'm going to go ahead and click on the high earners, and I want to apply this because you're going to see this cap rate number down here change once I load up these high earners here, and it just needs a minute to load.
What's your definition of high earner? Is it top 10, top 5?
Well, every market is different. So let me show you actually what that means. So I'm going to actually go back to all percentiles so I can show you the chart. So our definition of top earner, we say top 20%, but sometimes it's less, sometimes it's more. Look how evenly spread out this particular market is with earning categories. So in this particular market, the top earners are going to be your top 19.13% of the market. That means of the single family homes, 19% of them are going to be high earners, and they're going to be around a I'm going to say a 4-bedroom, 5-bathroom, 4-bathroom type of arrangement. I'm sorry, 4-bedroom, 2.5-bathroom arrangement with about 5 beds. So this is right here exactly what the average top earners are in this market and how much of the market they saturate. We've seen markets where 40% or 30% of the market are top earners. So really, this is a very evenly distributed market. We really don't see this very often. So it's interesting. And then you have another 19.13% that are middle high earners, which means they're doing better than middle earners, but they're not quite high earners yet. So you have this other 19% of the market that has the potential to possibly buy these at a lower purchase price and then push the earning up. So these right here might be the portion of the market that we want to focus on buying. And of course, if we can buy the bottom earners and turn them into top earners, we're always going to get those at a better price. And that's going to drive huge amounts of cap rate opportunity. But let me go back up here and let me pull the top earners so we can really look at what those numbers look like once you are a top earner and how we can actually do better than that. Because that's what I'm looking at when I'm analyzing these markets for STR. So what we see here are the high earners doing between a 12.2 and a 14% cap rate. I'll buy at that. I'm good with that cap rate. I have a 10 minimum requirement. Everybody's buy box is different, but this meets my buy box here. The question is what do I have to spend to get that? In most markets, to get a cap rate like this, like straight out of the box, we're spending upwards of, $900,000. We're buying a luxury property, and then, we still have to do stuff to get it there. It looks like here in Cleveland, our average purchase price for a top earner is around $365,000. That is super entry level for any investor. We have so many investors that they're just starting out in short-term rental and they don't want to take the risk of buying $1 million house, which you have to do in a lot of markets to get those tourists. So this presents an opportunity for the entry-level short-term rental investors to get their feet wet in this market with potentially high returns. So you don't have to spend a ton of money to make a top earner here. So let's break this down into the cap rate range. This kind of shows us an even distribution across the market of what each bedroom size is going to do as far as a cap rate goes. So we really, unless we go up to, there's probably some outliers up there where we have 1 or 2 that are just crazy 8-bedroom houses doing something wild. I'm going to focus on
bachelor and bachelorette parties right there.
Yeah, exactly. There's all your parties. They're killing it. And we could definitely take a look at that. But this is pretty evenly distributed across most bedroom sizes. And I see here there's a little bit of a bump in the smaller 1 and 2 bedrooms, which is probably because your anniversaries, your weekend stays, you're getting out of the suburbs for a week or a weekend. That's kind of like what these smaller ones represent. And again, I'm not an expert on the Cleveland market yet. I'm still learning about why people go here and what they want. But the data tells us so much before we even need to go there. So we do have a big bump in the 2 bedrooms. So what I'm looking at here are 2-bedroom single family homes, the smaller ones, but that doesn't mean we can't perform well in a 3 and a 4 plus. So let's take a look at the market saturation here. I see also here that the 2-bedroom houses here in Cleveland, there's not a lot of competition. So this is a competitive analysis where it's showing you that these single family homes make up about 2% of the Cleveland market right here for short-term rental. And then we have like a lot more 3 bedrooms, which still is a small part of the market because it's also spread out with condos and townhouses. But this is still a small part of the market. You just have slightly more competition as a 3-bedroom. I can see here there's not a lot of competition across the whole market of Cleveland in general with single families. We might see more with condos. Now, I have seen some cool multifamily opportunities here where you're buying, it's still residential because you have less than 5 units. It's usually 2 or 3 units in one, where you've got a condo on one level and 2 condos on the bottom, or sometimes it's a duplex style, 1 floor, 1 floor. Though I underwrote some of those and those look really good because typically on the short-term rental side, it will pay for its mortgage with just one of the units. And then the secondary unit is typically going to be just straight cash flow. So that's another model I really like here is the residential multifamily model with the 4 units or less. And there's some of that here. Okay, so let's look at the occupancy rates. We're still getting for a market that's cold, and we see a lot of markets where they have brutal winters and they're just completely crickets for half of the year. We're still pushing like around 73% occupancy year round. That's really good numbers. Even 64 is really good occupancy for a market that's pretty much seasonal. So I don't know why yet, but there's some reason why people are going to this market more often than just the summer or the warm months. And that's what I'm in the process of figuring out.
Probably
So
NFL football.
exactly. And I don't know much about sports, but I had a feeling it had to do with sports. And that's probably why I don't know, because I don't follow it. So that's a good insight. And there's probably events like that happening. So it is driving those numbers. And there's probably a university or a college somewhere close by as well, because I do see a bump like this in university towns or college towns. And if there's hospitals, which there is, we also see that driving midterm stays as well. So sales prices, I mean, this to me is one of the main reasons why when I saw the cap rate, I looked at this market, because it's such good prices right now, because we have to be mindful that our money with inflation and interest rates, it's not going as far as it used to. It's not just the interest rate, it's the cost to set it up. The bigger houses have a higher cost. Goods cost more right now. Beds are more expensive. Materials for the home are more expensive. Supplies are more expensive. So sticking with this smaller property with higher returns model right now at a better purchase price, in my opinion, is the safest way to start investing in short-term rental in today's market until we see what's going to happen with the economy. So I'm seeing here 256 on average. Now, these are for top earners. These are not just, for any property. This means that like these green dots here on the map, let me expand them. There they go. These green dots, to try to purchase one of these on average, we're looking at about that number between 250 and 400 for a 2 to 3 bedroom. And I validated that to be accurate in my own underwriting research. And the numbers are coming in at that. So it is absolutely possible to get into this market at these prices and hit these returns. So let's look at some of the top features they have here in the high earning category. I'm seeing here a major trend of pet-friendly units. So whoever's traveling, somebody figured out that to be a top earner, if I let people's pets stay with them at the property, I'm going to make more money. And that's something I'm just going to follow, because the data supports this to tell me that 45% of these 2 bedrooms allow pets. So they're top earners, and most of them are pet friendly, which means they figured out the formula is we want to be pet friendly. So that when I factor that into my startup cost, if there's any carpet or anything like that, I'm going to rip it up, make sure the entire unit is either tile or wood or something that's, pet friendly and easy to clean. So we don't see pools at all as a factor in this market. Not surprising. It's cold. Nobody goes there to swim. And we see just a little bump in people with hot tubs in the top earning category. So it could be interesting if you want to become a top earner, if you put a hot tub in your backyard or somewhere on the property, because even though a lot of these top earners don't have it, it means that you'll be one of the few that do offer it. So it could be a way to attract those guests that see it as a bonus or want it as a requirement, especially if you're doing like bachelorette parties and things like that. Having that hot tub is going to be so important to part of that gathering.
Yeah. So this basically tells you not having a pool is in no way a deterrent, but adding it if you decided to might, or not having a hot tub is in no way a deterrent, but if you add it, it could potentially add value.
Exactly. It tells you how many people that are a top earner actually have it. So it tells you basically, like, with such small numbers, what we say is it's not a deterrent from being a top earner, but it is a bonus if you have it, because not a lot of them have it.
So if it was 75%, you're looking at a place without a hot tub, you're going to have to factor in putting in a hot tub if you want to be up there.
Yeah.
But in this case, it's not the case. All right.
Yeah, exactly. You don't have to. So maybe it's something you add in year 2 after you get those startup expenses covered and income starts rolling in. This could be like something you add for year 2, and then maybe it will increase revenue a little bit. Maybe it will be the difference between somebody booking your unit and not booking somebody else's. So I would always try to throw it in if I could up front. If not, no worries, add it next year. Washer and dryer, this is not something that we even really need to talk too much about, but older properties that were built, in the early 1900s, which is a lot of times in these cities, sometimes they don't have washers and dryers, and that does have an effect on them becoming a top earner by not putting those in. So the majority of these top earners did go ahead and install a washer and a dryer. So I see that as an absolute necessity. If it doesn't have it, you need to put that in. These don't have gyms because they're not in communities. So if it says gym here, that means that somebody has gym equipment at their property, or they have some way for them to be able to exercise using gym equipment while they're there. And then we see a big bump in event-friendly units in these 4 bedrooms and these 7 bedrooms. So I think you were right for sure about, the larger the home, that's where those bachelorette parties are happening, because we do have more that are event-friendly than not, on the smaller units. So fireplace as well seems to be something that's a thing up there, but I don't think that's going to make or break the unit. So those are just like the features we want to look at and factor into expenses. The main expenses I get from this right here is just the cost of a hot tub. If it doesn't have a washer and dryer, I'm factoring that in. Maybe I'm going to put some gym equipment in the house. And I'm definitely going to make it pet friendly, which would mean, from an expense perspective, fencing in my yard and taking out all the carpet. So that's the top earner formula right there on how to be like the other ones that are also top earners. So let's look at some numbers here, because, we want to pay attention to these gross revenues. Now, these gross revenues aren't super high, but we're still hitting really good cap rates here because we're buying at
we're
great
only
rates.
putting in 200 grand into a property.
Yeah, exactly. And if we're taking a mortgage on that, there's plenty of room here to pay the mortgage and still make a profit because the cap rate's so high. So, to me, what I'm seeing here, and this is so hard to find anymore, is room to pay the mortgage, room to pay the expenses, which operate on a short-term rental at about a 50% expense ratio of your gross income, and room for a profit after that. And then when interest rates come down eventually and you refi out of that loan, you have even more profit. So rule of thumb here on how to look at this is, if you're going into the market of Cleveland and your gross revenue is around 60,000 and you're buying at around 250, you can mentally note you're going to be around a 17 to a 19 cap depending on expenses. If you're buying at a lower number and your revenue is here, obviously your cap rate's going to go up. If you're buying at this number and your revenue's less, your cap rate's going to go down, but there's plenty of room for error here at these cap rates. That number starts to kind of go down a little bit in these middle bedroom sizes, and then it jumps back up again. Now, what this 8 bedroom, keep in mind, this is probably an outlier or two where these homes were purchased really stupid cheap, or maybe they bought a duplex, converted it to a full house, something like that, and they're just driving insane numbers because the purchase price is like $39,000.
Yeah,
so they probably
put hundreds of thousands of dollars into that property
so
after
I
they
wouldn't
bought it that you don't know about.
Exactly. I wouldn't get too excited about that number there, but these other ones are most realistic scenarios. So could you buy a 1 bedroom and convert it into a 2? Sure. If there's a garage or something, you could buy a 1 bedroom at a lower purchase price, convert it to a 2 bedroom, and hit this number right here, and then get an even better cap rate than this. So there's a lot of ways to approach this market from a strategic perspective. But I see this as a high opportunity market. And believe me, we look at so many different markets. The key here that I don't know today, that I can't share with you today, is why are people coming here and staying such a long time out of the year or year round? That's the information I'm working on gathering right now. My agent has all that information. But it's so great to have these numbers because we have the blueprint now on what to do there. So we know where to buy in that Ohio City neighborhood. We know what numbers we have to hit based on which purchase price. We know our expense ratio. It's pretty standard across short-term rentals. If we can hack any of that other than the location, you're going to be doing even better in this market. So that's what the challenge is to go into this market, try to find a better purchase price, and drive your revenue through the roof by doing a ton of value add and making it super friendly for, renters, and great marketing, stuff like that. And management is also going to be key to success here, because if you don't hire the right manager And this is part of the process why I try to work with only the best agents in these markets that have done short-term rental for years, because they know who to use for management and who not to use for management. Because if you go into this market throwing darts at the wall with managers, it could make or break the investment. So I'm super funny about that, because I've been in situations where I had really low performing properties and all I did was change management and they were high performers. And I'm sitting there like, what did I do wrong? It wasn't even me. It was bad management. They're not,
You
your
chose
guests are
poorly.
checking. What's that?
You chose poorly is what you did wrong.
Exactly. Your guests are checking in. They didn't do any check ahead of time to see if it was clean. They have a complaint. It took them too long to get to it. So that's what could really kill you. So inventory analysis, I mean, we don't need to go into every single detail here. But as you can see that of the top earners, these are older homes. These are not new homes. So a top earner in this market is on average, built in the early 1900s. A couple of them built, 76, 1985, but on average, these are built, a long time ago. These are old homes. So we want to make sure that we're budgeting for potential piping issues, like if we have to repipe the house or if we have to deal with any kind of running more electrical to the house. Maybe we want to add an ADU to the backyard. And that's in our 2-year plan with this house, is maybe we're going to buy a duplex and then add an ADU to it on year 2. If we do that, we're going to need to be able to run more electricity to the house, be able to budget that in. So because these are older homes, there's going to be different types of startup expenses or value add expenses that we might not experience in a newer market. So it's good that we have visibility into that. Also, you don't have to have a huge house to be a top earner here. It really only takes about on the 2 bedrooms, around 1,300, 1,400 square feet. And then, the largest I'm seeing anywhere is 2,800 on the 7. And then we have this outlier 8-bedroom that's just a mansion, which again, let's try to ignore this
for 40
one.
grand.
Yeah, that they bought for 40 grand. I don't even know what that, I want to know what that is, but
I wouldn't have wanted to see it whenever they first bought it, I think. I'm
No
guessing that
way.
looks like one that was like razed to the ground and then
yeah,
put back
Yeah.
up or something like that.
it was in ruins and they just rebuilt the whole thing. So, but yeah, so we don't need a huge house here. They're very humble houses and we don't need a lot of square feet to make people happy. Yep. So that's kind of like your main stuff to really know. We kind of talked about the rest of this. So this is why I'm loving this market. This is the underwriting process we go through before we ever recommend markets to anybody. And if it wasn't a market I would buy in myself, I would never suggest it to anybody. And, I know you guys are the same way. So we found about 2 or 3 other markets like this right now in the US, and we're still digging for more. We're sifting through for gold. It takes a long time because our data does turn up opportunities that we look into and we investigate. And sometimes when we dig further, we find out, well, there's not enough tourism, or we find out, the properties are cheap, but they need way too much money to fix up, or whatever the cost might be or reason might be. So that's why the underwriting process for us takes a little longer. So if you're looking for non-traditional emerging markets, great opportunity here. Again, it's not like you can just go there, buy anything, and you're going to make a bunch of money. There's a strategy behind it. But I feel good putting our name on this one right now.
Yeah. You've mentioned the word saturation a few times in today's interview. And one thing I wanted to ask was, how do you know if it is saturated? I mean, you might see, growth in terms of new builds, but that could be new builds for, long term. It could be for short term. How do you know if you're buying in an area that there are too much new supply coming in?
Yeah, so that's a good question. It's a number we internally track. It's not yet on our data tool for other people to see, but it's a number we internally track with the supply of short-term rentals. So because we're pulling all the data from Airbnb, TripAdvisor, Booking.com, Vrbo, and we do this every month, we track the supply numbers over the last 3 or 4 years. And we see like which markets are starting to grow unproportionally to the amount of people that are traveling there. And so internally, that's how we track the saturation level. If you're trying to do it, on your own without consulting with anyone or working with data, the best thing you can do is really look for, and it's a process, it's a lengthy process, but really go through Airbnb and look to see how many units appear to be not rented very often. You would look at the calendars. So you would go to Airbnb and you would click on the calendars. Let's say you're interested in like the 3 bedrooms. You'd filter it out and you'd start to zero in on an area and just check to see if these calendars are booked out going forward. If they're not, there's probably just a lot of competition in that market. If they are, then even though there's a lot of competition, there's enough of them there to stay booked. So future bookings is also important to look at as well. But we use data to do that. And that's why we, when we're working with people, we share that knowledge with them.
Yeah. All right. Yeah. Fantastic. So you want to look at, so basically the growth in short-term rentals versus growth in tourism. As long as those are staying roughly in line, it's probably okay, and think that it's not saturated too much.
Exactly. It's supply demand like anything else. Yeah. When COVID happened, there was so much supply and no demand because nobody could do anything. But that was just a temporary situation. So if we see numbers like that in a market where it's wide open, then there's a problem for sure. And also too, look at the tourism numbers down here and check and see, like, are they trending back upward and getting closer to the pre-COVID number? Because if they are getting pretty close to that number, like the domestic number is getting up there, but the international number is not. So if the international number looked more like the domestic number, maybe I would probably not consider this market, but it's trending back upward. So I don't think anyone is to pre-COVID numbers yet, but they should be in the next, I'd say, year to 2 years maximum.
Yeah. And it also helps that the international numbers in this case were nothing compared to domestic.
Exactly. There's such a small
It's not an international hub for short-term rentals.
Yeah, it's not really. And they go to markets like Kissimmee and just different markets. It's not a thing there. Yeah. So yeah, that's kind of how we look at everything. And another thing too that people want to really like think about is, like I said earlier, is management, because that could make or break the whole investment. So even if the market looks good, is there an opportunity to find good management there? Because if there's not accessibility to good managers, good cleaners, things like that, it's going to kill the whole thing anyway. Cleaners are also super critical to this, because if, like, I have land, for example, in Murphy, North Carolina, and it's way out in the mountains. It's kind of like middle of nowhere, and it's beautiful. It's on a waterfall lot, and I want to build something there and do short-term rental. But it is so hard for me to find workers out there, like especially cleaners that will go that far out to my house. If it was snowed in, nobody can get in there, nobody can get out. So it's one of those things where it would be a passion project if I did it, but I wouldn't build there because not for any other reason except for it'd be very difficult for me to run it with the type of, the accessibility to workers I have there. Yeah. Otherwise, the unit itself would kill it.
Yeah, you need to create a ADU just to house your cleaners.
Yeah,
for,
exactly. Exactly.
All right. Well, Erica, thank you so much for joining us today. I really appreciate it. Everybody, if you want to find out more about the company and kind of how they operate, go to renttoretirement.com/find STR. That's renttoretirement.com/find STR. Again, Erica, really appreciate you spending the time with us today to educate. I know short terms and midterms are very, very hot topics in the investing world today. Just real quick before I let you go, you mentioned finding these in the average stay being 7 days. How do you know, kind of what are a good metric to look at to see if midterm is an option for a market?
Yeah, so we actually have that data. Right now we're pulling in Furnish Finder data. It's not in here yet. So we really can only look at Airbnb, and you could go to furnishfinder.com. And I don't know if I could share my screen, but if you go to furnishfinder.com, like, look at those cap rates on the MidStays here. They're actually killing it. They're really killing it here. And their average stay is around 60 days. But furnishfinder.com is the largest mid-stay. It's like an Airbnb OTA. So if you weren't using our data tool to look at these numbers, you could go to Furnish Finder and go to the market, type it in, remove hotel stays, because they do have a hotel and a room stay option. Remove those and look at the individual units that are there, how much inventory there is. You don't want to see too much inventory that's not rented out, because that means there's more than people need.
Yeah.
But if you have, a healthy amount of inventory there, but not too much, and you see their calendars have been booked, then you can get an idea if it's a thing there. You can also just go on our data tool, and find it there as well. So,
all right.
Yeah.
Really appreciate it. Again, the website, renttoretirement.com/find STR. Don't forget, you can also go to renttoretirement.com, find some long terms. We have some available in the Cleveland area if you're interested. And if you want to see Zach's copy of the top 20 markets to invest in 2023, just send an email to podcast@renttoretirement.com and we'll get that sent over to you as soon as possible. Really appreciate the time you spent educating yourself today. Don't forget to leave a review on whatever podcast platform you use. If you leave a review, take a screenshot and email it to podcast@renttoretirement.com, and we'll send you a $10 thank you gift card, as well as enter you into a $500 closing cost raffle that we'll be doing on July 1st of 2023. Again, appreciate the time you spent educating yourself today, and we'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.